Here is a number that should stop you mid-scroll. One single investment, not a tech stock, not a bond fund, has delivered a total return of over 1,600% since 2007, with dividends reinvested. And most people have never heard of it. Today, we are breaking down 3 income-producing assets that the majority of investors walk right past. One comes from energy pipelines, one comes from private lending, and one, the one behind that up to 40% yield in the thumbnail, comes from a place you probably would not expect. But here's the part nobody mentions about that 40% number. The yield on the front of the fund is not the same as what ends up in your account, and by the end of this video, you'll know exactly why and what to do about it. Quick note, I am not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, if you're somewhere in your 50s or early 60s, you've probably had that moment. You look at your portfolio, mostly in the S&P 500, maybe a few dividend stocks, and you wonder, is this diversified enough? Because once you're 5 or 10 years from retirement, that question carries real weight. Today, I'm going to show you 3 completely different places your retirement income could come from. We'll start with the steadiest and work our way up to the one with a yield so high it sounds like a mistake. Whether it actually is one depends on something most people never check. Stay with me. Asset number 3, the energy pipeline play. Let's start with the one that flies under the radar. It's an ETF called MLPX, run by Global X. It tracks companies that own and operate energy pipelines, the infrastructure that moves oil, natural gas, and fuel across the country. Here's the key. These companies do not drill for oil, they don't explore for gas, they charge fees to transport energy through their pipelines. Think of it like owning the toll road instead of the cars driving on it. That fee-based model is the reason this sector held up when the rest of the energy market took a hit earlier this year. In the first half of 2026, midstream pipeline companies outperformed the S&P 500. When oil prices dropped over 30% in the second quarter, broader energy stocks fell more than 12%. Midstream, up about 1%, barely flinched. So what does MLPX actually pay? The yield sits around 4%. It pays quarterly, and the expense ratio is 0.45%. Now, 4% doesn't make a headline, I get it, but look at what comes with that 4%. MLPX is up over 25% year-to-date in 2026. Over the last 3 years, it's averaged about 27% annually. Over 5 years, roughly 21% per year. That's income and growth working together. And here's a detail that matters a lot if you're in your 50s or 60s and you dread tax season. MLPX avoids the K-1 form. If you've ever owned an MLP directly, you know how painful that paperwork gets. MLPX uses an ETF wrapper. You get a simple 1099 instead. On top of that, natural gas demand is surging heading into 2027. New LNG export terminals are coming online, and data centers are driving enormous power needs. Pipeline companies are locking in multi-year contracts. That's the kind of structural tailwind you want behind an income position. Have you ever held an MLP in your portfolio, or is this completely new to you? I'm curious. So MLPX gives you steady energy income with growth and clean tax reporting. That's asset number 3. But asset number 2 has been quietly outperforming almost everything on the market for nearly 2 decades, and most people have never bought a single share. Asset number 2, the private lender paying you monthly. This one is a company called Main Street Capital, ticker symbol MAIN. It's what's called a BDC, a business development company. If you've never heard that term, here's the plain English version. A BDC lends money to smaller private companies that can't easily get a traditional bank loan. Those companies pay interest on the debt, and the BDC passes most of that interest income directly to shareholders as dividends. So instead of buying a bond fund paying 4%, you're investing alongside a lender that charges 8, 10, sometimes 12% interest, and you collect most of that. Big difference. Main Street Capital has been doing this since October 2007, and here is the headline. Since that IPO, Main has never once reduced its regular monthly dividend. Not during 2008, not during the pandemic, not once. Right now, the monthly dividend is 26.5 cents per share. On top of that, they pay supplemental dividends. The latest one was 30 cents per share in September 2026. When you add the regular and supplemental dividends together, the effective yield lands in the range of 7 to 8%. Let me think through the math on this. Say you are 55, you've got $600,000 saved, and you decide to put 5%,
$30,000 into Maine at today's price of about $59 a share. That gets you roughly 508 shares. At 26.5 cents per month, that works out to about $135 in monthly income from one position every single month. And since that IPO, Maine has paid over $50 per share in cumulative dividends. The IPO price was $15. They've returned more than 3 times the original share price in dividends alone, and the stock has grown on top of that. Total return with dividends reinvested? Over 1,600%. Here is the myth. BDCs are just risky bond substitutes. Here is the truth. The best BDCs have delivered equity-like returns with a monthly income stream that bonds cannot match. But I need to be honest about the risks. BDCs are sensitive to interest rates. Most of their loans have floating rates, meaning when the Fed cuts rates, BDC earnings drop. The sector has pulled back about 31% from its early 2025 highs, and the entire BDC universe is currently trading at about 83 cents on the dollar compared to its historical average, a 14% discount. Now, you could see that and think, stay away. Or you could see what smart investors approaching retirement see. Quality on sale. Discounts like this showed up in 2015 and early 2016. Both times the sector recovered. Quick question before we move on. Of these 3 assets, which one would you actually consider adding to your portfolio? MLPX, Maine, or the one we're about to cover? Drop it in the comments. I read every single one. So Maine gives you monthly income from private lending with nearly 19 years of proof behind it. That's asset number 2. Now we get to asset number 1, the one behind that up to 40% yield in the thumbnail. This is where we need to have an honest conversation. Asset number 1, the 40% yield question. All right, the one you've been waiting for. The asset behind that headline number is a Bitcoin income ETF. There are 2 versions, both from Neos Investments. The standard one is BTCI. It holds spot Bitcoin ETFs and uses a covered call option strategy to generate monthly income. Then there's XBTCI, the boosted version, which uses approximately 1.5 times leverage to amplify both the income and the Bitcoin exposure. BTCI currently pays a yield of about 27%. The boosted version, XBTCI, has a forward yield near 49%. That's where the up to 40% came from. And at today's numbers, even that was underselling it. But here's where most people stop looking, and it's exactly where you need to keep going. If BTCI is paying 27% in distributions every year, what do you think the total return has been since it launched in October 2024? Take a guess. Pick a number in your head. Got it? Since inception, BTCI's average annual total return is negative 3.7%. Negative. The fund has been paying out roughly a quarter of its value in distributions each year, but the price has fallen faster than the income has come in. Let me say that again so it lands. A 27% yield, a negative total return. That's not a contradiction. It's how covered call ETFs work when the underlying asset drops. The distributions you receive are largely classified as return of capital. That means the fund is giving back a portion of your own investment and labeling it as income. And here's the tax detail that matters a great deal if you're approaching retirement. Return of capital lowers your cost basis in the fund. When that basis reaches 0, and with a 27% distribution, it could get there in about 4 years. Every distribution after that point gets taxed as a capital gain. In a taxable brokerage account, that can create a surprise tax bill at the worst possible time. If you and your spouse are planning retirement income together, this is the part you both need to hear. Now, does that mean you should never touch it? Not necessarily. Bitcoin is around $63,000 right now, down 30% from the start of the year. If you keep the position small, 2 to 3% of your portfolio, inside a Roth IRA where the return of capital tax issue doesn't apply, the income can compound without the tax drag. But the key word is small. This is not a core holding, not for someone within a decade of retirement. Let me put all 3 side by side so you can see the contrast.
Look at that. The lowest yield on the list, MLPX at 4%, has the strongest total return this year. The highest yield, XBCI at 49%, belongs to a fund whose total return has been negative. That pattern is not a coincidence. It is the most important lesson in income investing. The number on the front of the fund is not the number that ends up in your pocket. Total return is what pays for retirement. The 3-source income framework. So, let us bring all 3 together. Each of these solves a different problem in a retirement income portfolio.
MLPX gives you energy income with growth and clean tax reporting. That is your diversification anchor. Maine gives you monthly private credit income backed by the longest track record in the BDC space, currently at a discount. That is your income workhorse. And BTCI gives you exposure to Bitcoin's volatility premium, high distributions, real risks, small allocation only. That is your satellite position, not your foundation. Here is one way to think about it if you're 55 with $600,000. And let me be clear, this is not a recommendation. It is a framework. Keep 85 to 90% of your portfolio in your core holdings, the S&P 500, diversified dividend ETFs, bonds. Then maybe 5% goes to Maine for that monthly private credit income. Another 3 to 5% goes to MLPX for energy diversification. And if you're comfortable with the risk, 2 to 3% into BTCI inside a Roth IRA. That's it. You do not need to go all in on any of these. Smart investors approaching retirement do not chase the highest yield. They build income from multiple sources, so no single one can hurt them. If someone you know is building a retirement portfolio and only holds the S&P 500 and maybe 1 or 2 dividend stocks, share this video with them right now. These are the income sources they are probably missing. I want to hear from you. Which of these 3 would you add to your portfolio first? MLPX, Maine, or BTCI? And if none of them, tell me what you would pick instead. Drop it in the comments. If you're building income for retirement and want to stay ahead of changes like these, subscribe to Dividend Hustle. I break down strategies like this every week so we can build smarter portfolios together.